Welcome to today's episode. I'm Andrew Wilkinson. So this week, the Federal Reserve indeed eased policy by 25 basis points at its September meeting. And the outlook seems to be, the consensus seems to agree that there will be more before the end of the year. To discuss with me, I'd like to welcome back to IBKR podcast, Erik Norland. Erik is the group economist with CME Group over in Europe. Welcome, Erik. How are you?
I'm doing well. Thank you for having me.
You're always welcome back on this program. Now, the employment situation has deteriorated markedly in the past several weeks. To that extent, did the Fed surprise you at the meeting yesterday?
It was widely expected. So if you look at our Fed funds futures and market had priced basically 100% chance of 25 basis point cut and even some additional probability of a 50 basis point cut. So it didn't really come as a surprise to me. Certainly didn't come as a surprise to the market. But when you look at the employment situation, it's not really that bad. It is true that non-farm payrolls have barely grown in it for the last few months. They're also not negative. It's like nobody wants to make any decisions here. So nobody's hiring, but nobody's doing mass layoffs either. So the labor market just stalled out. But on the other hand, you look at wages, wage growth is still 3.9% year on year. The unemployment rate still at 4.3%. It's been creeping up very slowly, a few tenths of 1% per year for the last 2.5 years. But there was really nothing in the labor data that struck me as so alarming that we immediately had to cut rates.
So what are the risks, Erik, of easing monetary policy when inflation is still above target?
So, headline inflation is already at 2.9%. Core inflation, more worryingly, is at 3.1%. Both of them have been rising recently. This is part of a global trend. You look around the world, and I can only think of two countries that I know of that have below target inflation. There's China, which is a big one, and Switzerland, which is a not so big one, but a wealthy one. Everybody else has inflation above target, and almost all those countries, like the US, are seeing it starting to rise. And yet all of these central banks, for some reason, are cutting interest rates. And so I think the risk is you wind up with a great deal more inflation down the road. And what I would point to would be the early 1970s when President Nixon appointed his friend and political ally, Arthur Burns, to run the US Federal Reserve. And he kept monetary policy for too easy for too long. And we wound up getting inflation to go from 2.5% up to around 12% by 1974. And by the time Arthur Burns left the Fed in 1978, inflation was running around 6, 7, 8%. And then Carter replaced him with his friend and political ally, G. William Miller, who essentially coordinated Fed policy with the Treasury Department, but was described by one of Alan Greenspan's biographers as being the most partisan and least respected person ever to run the Fed. He managed to get inflation up to 14%. So that's what the risk is.
And I think you and I were talking about this just moments before we started recording. When I was trading money back in the 90s in London, the Bundesbank, the German Bundesbank, its sole mandate here was inflation, was it not? And what do you think the chances of getting an interest rate cut out of the Bundesbank would have been yesterday?
Oh, they would have raised rates. If it was the Bundesbank, they would not have cut. They would have been raising rates, I can tell you. Even in the early days of the ECB, the first two ECB chairmen, Wim Duesenberg and Jean-Claude Trichet, even though they were Dutch and French, basically created the ECB as like a Europe-wide Bundesbank. And the two of them used to constantly in every press conference, talk about the importance of keeping inflation expectations anchored.
Yeah.
And the problem is that inflation expectations in the US are coming unmoored. If you look at the University of Michigan Consumer Confidence Survey, the most recent number shows Americans expect 4.6% inflation in the next year. They expect 3.9% average rates of inflation over the next 5 to 10 years. This is very different than what they expected a few years ago, and they're expecting more like 2 to 3% inflation. But so the problem is consumers, as they come to expect more inflation, it can become a self-fulfilling prophecy. If you think your money's going to lose its value, what do? You rush out and you spend it very quickly, which boosts demand, boosts consumer spending, but then causes that demand to outstrip the supply of goods and causes prices to begin drifting higher.
Erik, you've mentioned the labor market and inflation, discussed monetary policy. What are your overall thoughts about the US economy from where you're situated?
The US economy has a lot of sort of contradictions, and there is a case for cutting rates. So Unemployment's been drifting upwards in the US for quite some time now. We hit its bottom at 3.4% about 2.5 years ago in the second quarter of 2023. It's out to 4.3%. So there clearly is a softening of the labor market. But at the same time, there's huge numbers of open positions. You have 7.3 million jobs opening, according to the JOLT survey, which is about as many as we had at the peak of the expansion in 2019. You look at consumers, consumers express a lack of confidence to survey takers. If you look at the University of Michigan or Conference Board, they basically say we don't really feel confident in the economy. Then there's a question of who's not confident. So the people who are not confident are primarily those earning less than $100,000 a year. The difficulty, though, is people earning more than 100,000 are seeing their stock portfolios at records. They're earning a lot of income and they're spending a great deal of money, and they're driving actual consumer spending higher month after month. Then you look at things like default rates. So on the one hand, you have rising default rates on credit card loans and auto loans, all of which would suggest consumer stress. And indeed, there are many American families that are stressed, especially those on lower incomes. But even you look at the credit markets, we have new futures here at CME on high yield bonds and investment grade bonds. Those spreads have never been narrower than they are today. And so you have the stock market at a record, you have narrow credit spreads, you have a reasonably strong economy, you have inflation is creeping up. And so the overall picture is an economy that might be getting ready to overheat, and we might be pouring gasoline on the fire by cutting interest rates in this environment.
Erik, let's turn to recent political events in France. Were you surprised at investors shrugging the shoulders with the latest collapse inside the French government?
I think it was widely anticipated. As a result of the elections held in July last year, or June last year, the National Assembly essentially has a third on the left, a third in the center, and a third in the right. So pretty much anybody who Macron chooses is going to struggle to run the country, which is why he's going through prime ministers at such a rapid clip. Yeah, that said, there is some degree of distress in the French debt market. So the ECB has been lowering their rates. So French 2-year and 5-year bonds, the B10s, have been coming down in yield. But the longer term ones, the OATs, the 10-year and especially the 30 years, have generally been rising. Maybe not over the last week or two, but certainly over the last few months, their yields have been increasing. And so I think there's a lot of reticence on the part of investors to lend money to the French government long term. And they're not alone. The UK's government, Japan, also in a very similar situation.
Erik, we're heading towards the end of September, which means we'll be jumping into the fourth quarter. Any thoughts on the rest of the year? What does that hold in store for investors?
What we've been seeing from investors so far, especially in the third quarter, has been a strong desire to buy assets that central banks cannot create. So they've been pouring money into gold, silver, platinum, and palladium. They've been buying certain cryptocurrencies, especially Solana and XRP, but also Ether and to a lesser extent, Bitcoin. And they have been avoiding these long-term government bonds for the most part. Although we did have a little bit of a rally in the long-term treasuries. That seems to be over now. But then lastly, they're still plowing money into technology companies. And so I think that with a rate cut, this party might really get going, especially if the Fed keeps easing policy as it signaled it's likely to do. It said it expects to cut at least 2 more times into year end. So you combine that with possible tariff effects on inflation, we could see consumer price inflation drifting higher as rates come down. And that could really get people interested in buying things that central banks can't print.
It's going to be a little strange from here, because if the stock markets go up, it's going to give us the sensation that everything's okay. But if the stock markets come down, we're going to start feeling that concerns about the wealth effect, or that the reality might seem worse than it actually is, right?
Yeah, the analogy I would make would be what happened in 1971. So after Arthur Burns had been in office for about a year, he and Richard Nixon basically severed the link between the dollar and gold, which meant a massive monetary expansion in the US ahead of the 1972 presidential election. So you might laugh at this, but this happened on Sunday, August 15th. When the markets reopened the next day, on Monday, the 16th of August, 1971, the Dow had its biggest up day ever. It was up 33 points. And so the market continued to rally. It had a really nice rally by the standards of the time through December 1972. So it had about 16 months of rising prices. It was basically a 16-month-long party at the beginning of Arthur Burns's helm at the Federal Reserve. Then inflation really struck. Then what happened next is the stock market fell 47%. Inflation went to 12%. The bond market crashed. Yields soared. Investors lost a lot of money. We had an extremely deep recession amid higher inflation. So unemployment went from 4.4 to 8.8%, maybe in part because of a wealth effect hitting investors who had lost so much money in the stock market and the bond market simultaneously. Meanwhile, gold prices continued to soar, silver soared. It was a pretty interesting middle part of the decade. And that's the kind of thing that could potentially result. We could see the market go much higher, meaning the equity market much higher. But then eventually, if we get hit with higher inflation, the Fed may have to reverse course, may have to raise rates a great deal like they did in the 70s. And then that could be very negative for the stock market, especially given its extraordinarily high valuation levels.
Mm-hmm. What was it they say the cure for a high stock market is?
I don't know. Commodities, you say the cure for high prices is high prices. It incentivizes production. I don't know what the cure for high stock prices is.
Higher prices, and then when they fall, they become more affordable.
Yes. That's the thing. There's so many investors that over the last really since 2009, have learned that any sell-off is a buying opportunity. And that will be true until one day when it's not true.
Yeah, and it certainly appears to be true back in April, following the launch of the tariff campaign. All right, Erik, thank you so much for joining me today. I always appreciate your insight, and particularly today, the history lesson.
All right, thank you for having me.
All right. And to the audience, thanks for joining me. Don't forget, if you enjoyed today's episode, to subscribe to this channel wherever you download your podcasts from.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Trading in digital assets, including cryptocurrencies, is especially risky and is only for individuals with a high risk tolerance and the financial ability to sustain losses. Eligibility to trade in digital asset products may vary based on jurisdiction.